Ladies and gentlemen, good day and welcome to the Ganesh Consumer Products Limited Q3 FY26 and 9 months earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Garima from Go India Advisors. Thank you, and over to you, ma'am.
Thank you. Good morning, everyone. I'm Garima Singla, and it's my pleasure to welcome you on behalf of Ganesh Consumer Products Limited. Thank you for joining us today for Quarter 3 and 9 months of Financial Year 26 earnings conference call. This call is being hosted by Go India Advisors. Please note that today's discussion may include certain forward-looking statements. Therefore, they must be viewed in conjunction with the risks that the company faces. Today on the call, we are joined by Mr. Manish Nimani, Managing Director, Mr. Amit Tapadia, CFO, and Mr. Narendra Mishra, CS and Compliance Officer. I now invite Mr. Manish to present the company's business outlook and performance, after which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Garima, and a very good morning to everyone joining us today. As we come together to discuss our third financial year 25-26 performance, I would like to begin by saying that this quarter represents an important phase of reflection and reinforcement for all of us at Ganesh Consumer Products. It has been a period where we consciously focused on strengthening the quality, resilience, and long-term direction of our business. Before I take you through our performance, I would like to sincerely thank our investors, partners, employees, suppliers, and all stakeholders who continue to stand by us and believe in our journey. As a relatively young listed company, the trust carries immense responsibility, and we remain deeply committed to honoring it through disciplined execution, strong governance, and transparent communication. When we began our journey, our vision was simple yet deeply aspirational: to bring authentic, high quality, and affordable food staples to every Indian household. What started as a modest regional packaged staples brand has steadily evolved into an integrated consumer products company with a growing presence across flours, sattus, spices, powders of all cereals and pulses, and ready-to-cook instant mixes. Our story has always been about maintaining a careful balance between tradition and transformation, staying rooted in our heritage while continuously adapting to modern systems, evolving consumer preferences, and structured operational processes. From our strong sourcing networks across Uttar Pradesh, Madhya Pradesh, Rajasthan, and parts of Western India, to our rapidly expanding distribution ecosystem, supported by integrated marketing initiatives and digitalization, this blend of the old and the new continues to define our growth journey. Coming to our performance during quarter third of financial year 26, the quarter represents a technical reset within an otherwise healthy growth trajectory. Revenue from operations stood at rupees 2,117 million. While this reflects a moderation compared to last year, it was a conscious and well-calibrated decision by the management. During the quarter, we responded proactively to intense price-led competition in select B2C market, while deliberately reducing exposure to lower margin B2B volumes. These actions were undertaken to strengthen earnings quality and improve the long-term structural positioning of the business. Despite this near-term moderation, our overall performance for the 9-month period remained healthy. For 9 months, financial year 26, revenue grew 3.6% year-on-year to to rupees 6,534 million, reflecting the resilience of our core portfolio and disciplined strategic execution. What gives us a strong confidence is how the business responded. EBITDA for the quarter grew significantly to rupees 228 million, reflecting a strong 37% year-on-year growth. EBITDA margins improved to 10.8%, expanding by over 300 basis points year-on-year, supported by improved realization, a stronger product mix, and operating leverage. Profit after tax demonstrated even stronger momentum, reaching rupees 121 million, representing a 57.6% year-on-year increase, with PAT margin expanding to 5.7%. These outcomes clearly demonstrate the increasing operating strength and scalability of our business model. Our B2C franchisee continues to remain resilient despite heightened competitive intensity. While B2C revenues remained broadly stable during quarter three, we successfully protected market share through strong brand recall and our deeply entrenched distribution network. This was achieved alongside margin improvement and disciplined execution of cash and carry model in the GT channel. Over the 9 months period, B2C revenues grew approximately 6% year-on-year, highlighting the durability of our consumer franchisee even in a competitive environment. At the same time, we undertook deliberate portfolio optimization within our B2B business. B2B revenues declined approximately 12% year-on-year in quarter three, driven by our conscious decision to scale back lower margin opportunities. The spices segment, in particular, continues to emerge as a strong growth and profitability driver. The segment delivered nearly 31% year-on-year growth in 9 months financial year 26, reflecting our strategic focus on expanding value-added, higher margin categories and enhancing overall portfolio quality. Our digital and quick commerce channels also continued to demonstrate strong traction, with revenues growing approximately 58% year-on-year during the 9 month period. This reflects we were able to collect evolving consumer purchasing behavior and validate the strength of our multi-channel distribution strategy. Over the past year, we have consistently focused on strengthening the structural pillars of our business. Our distribution network today spans more than 350,000 retail touchpoints across traditional trade, modern trade, digital channels, enabling deeper market penetration and improved product availability. Our product portfolio now includes more than 200 SKUs, allowing us to cater to diverse regional consumption preferences while aligning with emerging national demand trends. Another important milestone during the year has been the strengthening of our financial position. Following repayment of borrowings, the company now operates with a debt-free balance sheet and maintains a surplus cash of approximately rupees 1,100 million as on date. This enhances our strategic flexibility and position, as well as to accelerate our brand investments, expand distribution reach, and pursue future growth opportunities from a position of strength. As we look ahead, our strategic priorities remain clearly defined. We will continue scaling our B2C portfolio with sharper focus on core categories and value-added product extension. We will deepen distribution penetration across existing and new geographies while strengthening our presence in modern trade, QCom, eCom, and all modern trade channels. At the same time, we remain committed to sustained brand investments, data-driven demand planning, strong working capital discipline, and continue margin expansion through product premiumization and portfolio mix improvement. Growth for us has never been about chasing scale at the cost of sustainability. While the 1,000 crore revenue milestone remains a medium-term aspiration, our current focus is on strengthening the quality of growth and profitability. The consistent margin improvement we are witnessing reinforces our belief that building a strong and profitable foundation will ultimately drive more value-accretive growth and will be durable. With capacity expansion initiatives underway, strong category fundamentals and favorable structural tailwinds from increasing formalization in staples and packaged food sectors, we believe Ganesh Consumer Products is well positioned for sustained and profitable long-term growth, creating enduring value for consumers, partners, and shareholders. Before I conclude, I would like to express my heartfelt gratitude to our employees for their relentless dedication, our suppliers and distribution partners for their continued collaboration, and our shareholders for their trust and confidence in our vision. This remains the early phase of our journey as a listed company, and we are fully committed to building Ganesh Consumer Products Limited into one of India's most trusted and admired packaged food staple profitable companies. Thank you once again for joining us today. We will now be happy to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Good morning to your team and thanks for giving me the opportunity. So my first question is around your working capital dynamics. So you have mentioned that your spices portfolio currently has a credit period of 15 to 30 days, unlike your staple business, so which is largely advanced risk. So as spices grew by 31% in 9 months FY26, so how do you see this segment expansion impacting your overall working capital cycle, which is historically has been lean at 21 31 days? In the first question.
Hello, Amit.
So good morning, Amit here. So I'll answer that. I'll take up that question. So for spices, in the general trade, we are providing a credit period of ranging from 15 to 30 days. Now again, the distributors who are handling our core categories, they are working with us on the spices category as well. And hence we can control the overall credit which we provide to them. So working capital requirement, it will remain the same because spices as a segment is small as of now. And going forward, once we penetrate better in the spices category in the West Bengal market, we'll be able to streamline the credit line on the spices category. So hence we believe the working capital cycle will remain intact without any major change. Thank you.
Okay. So you have cleared that you are saying in West Bengal side you will face some of kind of credit longer period, right?
Sorry?
Like what you have said, you are saying that you will face some longer credit period in West Bengal side.
No. Yeah. So in West Bengal, currently the spices market is purely in West Bengal and we are providing a credit of 15 to 30 days. We don't feel that any longer credit period is required as of now. And as I said, going forward, we will optimize that credit period because once we penetrate better with the spices category, then we feel that we'll be able to command the credit period given to the distributor. And these are secured credits. We take PDCs, we also take bank guarantees wherever it is required. So that way it is secured credit.
Okay. And my second question is around your channel economics. So you have mentioned that your e-commerce and quick commerce segments grew by impressive 58% during 9 months FY26. So can you compare the contribution margin of these digital channels against your traditional general trades, especially considering general trade operates on a cash and carry model? So while digital channels often involve higher fulfillment costs.
Yeah. So again, the margins impact for us, it is better than the general trade. Yes, as you correctly highlighted that modern trade also enjoys a credit. So, but we try to optimize that because we provide a credit period in the range of 15 to 21 days, right? And we monitor the credit cycle very thoroughly. In case a player delays the payment, we stop billing them. That way, we are very much in control of the credit which we are giving to the modern trade players, right? And in terms of the contribution margin, as I said, it is better as compared to the general trade segment. And historically, if you see, we haven't had any bad debt in the books, in the P&L.
Yeah. Yeah. Okay. Okay. And one last question from my side around your capacity utilization. So your current capacity utilization stands at 55 to 60%. So to reach your 2028 revenue and EBITDA targets, so will the current 1312 million per day capacity sufficient, or will you need to transition the Hyderabad unit from its current job for a third party since to your own production?
No, so we don't plan to use Hyderabad unit for the GT channel. And as goes your question, so our current capacity is enough to meet the requirement or the demand which we foresee in the next 2 to 3 years, right? So that way we can achieve our Q3 FY28 vision with the same set of plant and machinery which we have. And going forward, maybe in this quarter, we will also commission the Agra unit, wherein we will start manufacturing atta. That will boost the atta manufacturing capabilities which we have without any major capex, because we already had a cleaning line. Also, we are working on a new category which is soya badi, which again should start in this quarter only.
Okay. Thank you for answering my all questions. I'll jump back in the queue.
Thank you.
The next question is from the line of Deepesh Sancheti from Manya Finance. Please go ahead.
Yeah, hi. Am I audible?
Yeah.
Yeah. Now, is the spices simply a growth pillar, or so there's some strategic angle to it also? And whether spices will improve or dilute the blended margins?
Hi, Amit here. I'll answer this question. So spices is both a strategic and a high growth category, because spices is a more than 6,000 crores market in the eastern part. It is a packaged market, and considering the supply chain base we have and the consumer trust our brand, we feel that we'll be able to cater the good quality needs of the consumer with our continued R&D effort on the spices segment. We are a kitchen brand, and it will go a long way for the spices category for us. And in terms of the margins, obviously spices controls a better margin as compared to our core categories, and we are very bullish that in a year's time it will deliver better margin as compared to the core category.
What gives you the confidence? I mean, what specific consumer insight have you seen which gives you the confidence that you will be able to win in this crowded spices market?
So, I'm Manish Memani. I would like to take the call. So the confidence comes from there are a couple of reasons for this confidence. One, if you see on the procurement side and on the manufacturing side, we are well entrenched. We have got a well position with our expertise, long-term expertise in the agricultural purchases, and up to the mark qualitative manufacturing. Now, if you come to the thereafter, it needs to be on the execution on the availability part. Now, on the availability part, we have got retail touch points of more than 350,000 touch points. From the same shops, all the kitchen staples are being procured by the consumers at large. So I think after procurement and manufacturing, the third important role which comes for a success of a brand in consumer space is availability. There also we have got a very good foundation. Now on the second last mile, that is brand recognition and brand recall. Because we are a decades old kitchen brand, well known, well consumed, well tested, day in, day out by the lakhs of consumers for decades for packaged staples. This is an adjacent category where I think if once we are tested and if we are able to convince the consumer that we are value for price material, so the repeat buy will come. So this is on a brand recall where we are well positioned. Only the last mile, of course I agree with you, this is a cluttered space. But again, you also need to appreciate this category is largely all the players, pan-India also. All the regional players are dominant players in this category. Even likes of NDH or average, in some states, they are lagging in a second or a third position. So by and large, the regional players understand more about the taste and preference in the spices category, which is a mota regional category. There we find, there the confidence comes. We are not going to go pan-India in spices as of now. We are only going to go for initially for Bengal, full-fledged, and then thereafter Eastern India. And we have done a lot of research and development in the last couple of 2-3 years before going full-fledged into the entire category. Our spices category includes of core, CTC and blended. So largely the blended margins will come from the blended one. And the acceptability, we are already, this is the 2.5 years pulse on a spice launch. And this year we are going to close more than 35 crores. So which is a way mark than last 2 years, which itself speaks about the acceptability of our brand. There our confidence comes.
Right. And what about the incremental cash? I mean, we have a significant cash with almost little debt. Now, what is the best incremental use of this capital which you are planning to do? And whether will you do any inorganic growth or that is a strict no-go?
Yeah, so I'll take that question. So we will strategize and we will spend very strategically on the distribution and branding of our products. Further, as you correctly picked up, we will also explore inorganic opportunities. Again, we don't want to venture into low margin categories. So we are exploring high margin adjacent categories, which goes well with our category, and we are very much open to opportunities in nearby geographies, which will expand our distribution network and will add to the current distribution wings of ours.
So will these inorganic opportunities will be buying the brands, or will it be only buying the manufacturing facilities, as we already have a very known and a trusted brand in the Eastern India?
So again, it depends on the asset which we are targeting, but majorly we will target the entire brand with distribution and the manufacturing setup, so that we don't want to basically deteriorate the customer experience by moving away from that particular market. So we will obviously we'll plan the transaction in a way that we get the best of the available opportunities.
Right. And also, how are you seeing the market? As in, we haven't seen any growth this quarter in terms of sales. And overall, how much sales growth do you see, and what gives you that confidence that we will see double-digit sales growth?
So in this quarter, in terms of the B2C segment, right, considering the competition from players like Imami, so Imami also launched consumer staples including atta, maida and suji. So in the B2C category, it's not that we have degrown. In the B2C category, actually there was a growth of close to 1%, right? Now, in considering a competition from company like Imami, which is a personal care, renowned personal care brand, we were able to maintain our market share. Now, as you will also appreciate that whenever a new brand comes in, they remain very aggressive in terms of pricing. So that way we were able to hold on to our market share. And meanwhile, so going forward, as it is, I know it is a forward-looking statement, but the month which just got ended, we were able to deliver a healthy volume growth in the B2C segment, right? So that way we are very much optimistic that going forward, in the coming quarters, we will be back on the growth trajectories which we plan to have. So any brand, whenever a new brand comes in, it is a matter of 2-3 quarters, and we are very much confident that considering the supply chain, the good quality manufacturing facility we will be able to get back to the growth trajectory which we projected for ourselves. And we will retain the market share, and obviously, one thing you should appreciate that we have maintained the profitability. Not only maintained, we have grown in the profitability terms. So if you ask me if a company burns money and starts distributing, it is easy to basically grow in the overall in the top line. But we are very much focused that we have to maintain the margin, we have to maintain the healthy financials, and we have to work on the cash and carry model in the GT channel. So that way, and you can see the EBITDA and margin has also improved in this quarter.
No, I appreciate that, sir, that you have maintained the margins and the bottom line. My only point is that, how will the company grow? Because most of the company's products are into, there is no entry barrier to the product. So any bigger brand, any pan-India player, whenever it will come, it will affect our growth. So what is the company doing to have the growth? Because at the end of the day, you will maintain the profitability, you can improve the profitability. But sales growth will be important to carry forward this entire profitability to the next level.
Yeah. So I appreciate your question. It's a very right question. So the confidence comes on the revenue growth from couple of reasons. Number one, of course, every then and there, a new player can come, big or small. But then according to us, as you said, there is no entry barrier, but according to us, of course, there is an entry barrier in any brand play FMCG consumer sector. Reason being, the bigger players have got advantage over distribution network. They can have manufacturing capabilities. But then to have a brand recall in that segment, in a food segment, is a different. Because if we largely see, the companies who have tried to grow very fast in food categories pan-India, historically, they were not able to get success. The reason being, you need to spend over the taste and preference of the consumers, one. Number two, just by having a distribution muscle power, it doesn't give you guarantee to have a consumer brand recall over food category. So we our organization comes from. A personal care company will be, the DNA of that personal care company is not a pure food DNA, but we are a pure food DNA company, legacy brand. So we understand food. Even any new player with a very heavy muscle power comes into this. They need to spend time. They need to understand the food preferences and on the brand recall. Any which ways, the medium ones and small ones, the entry barrier is there. For them, they will not able to expand so fast in distribution or manufacturing or brand building. So largely the risk only comes from the bigger ones, and at the same time, the market is also growing. And the overall, the conversion is there from the unorganized to organized market. So maybe a quarter, we were not able to grow quarter, but then you will appreciate on the PAT and EBITDA, we were not able to maintain, rather we increased our PAT and EBITDA, which was the highest in the last 3 quarters. So I think we are bullish. Moving forward, as we said, we will be spending more on the distribution to cover a target of up to 5 lakh touch points in another 1.5 years, and to come into more adjacent categories. So it will not only be growth in our core categories currently, we are seeking to move into adjacent profitable margin accretive adjacent categories, which are again related to kitchen only. So then there will be a mix of a strong execution of our current core portfolio penetration, going into new adjacent categories, as well as tap the opportunity of market growth.
Right, sir. If I can ask the last question.
Sorry to interrupt, Mr.
So just last question.
Can you please
last
rejoin
question.
the queue? Sir, there
Just
are
last
more
question.
participants in the queue. Can you please
Okay.
rejoin the queue?
Okay.
Thank you. The next question is from the line of Pritesh from Lucky. Please go ahead.
Yes, sir. Based on what you highlighted, so if you could tell us the category growth in general, on the volume side in your base category, which is what you call that? Presentation marker. Yeah, the carrier products, the carrier and the value-added products, which is a whole function of the different class. So, their slightly longer category growth, if you could tell us in volume. Secondly, in your presentation, you have talked about some competition and impact. So what was your strategy? And incrementally, how are you seeing your volumes in January or this quarter, based on whatever happened in the last quarter? I know that would be really helpful for us to correlate in terms of your growth path. And the other thing is, in the 9-month number, if you could just tell us so you have given a B2C growth, but if you could tell us what was your emerging category growth and, what was your base category growth. So base category is, let's say, the whole flour portfolio. These two things, if highlighted, would help us, make some guess on the future growth, keeping aside what happened in the 9 months or what happened in the quarter 3. Maybe you could sum this up and explain us, please.
Yeah. So, during the 9 months period, the atta category, in terms of the volume, has grown at around 13%, right? The other, 13%, 13. Right? And the other emerging categories, right, which includes other flour category and the emerging category, is so overall the atta, as I said. So, and category-wise, I think discussing over this platform will be, I don't think it will make sense, but on an overall basis, as you asked, the B2C revenue in terms of volume has grown at around 5%, and the overall, value-wise, the growth is around 6% in the B2C segment. And in the coming quarters, right, as I said, in the month of January only, we have grown recently at in the range of 8 to 10%, and hence we foresee that we will be back on track to a healthy 8 to 10% growth in the coming quarters.
So on this platform, we will like to say we will not able to give you individual growth or degrowth percentage, which we can respond to a particular mail. If you can mail us, we can respond to that mail.
No problem.
On an individual basis. Reason being, on this public platform, due to competitive intensity, we will not like to divulge the individual figures. One. Number two, on the overall, on the basis of January, which has just concluded, in which the rebound growth was there of in the B2C category of approx 9% in the volume side. So by that, we are very much hopeful in last fourth quarter, we will again able to grow well. Again, at the same time, maintaining profitability, EBITDA and PAT better than last year.
Okay. So just to sum it up, you said that the 9-month B2C volume growth is 5%. Okay, correct?
Yes. Yes.
In which emerging categories would have grown faster than your basic.
In compared to the growth, in compared to the core category, the emerging category, which included spices, had grown faster.
And your value-added category would have also grown faster than the flour, right? Or slower than the flour?
No, so that is lower because of the Sattu impact, as we had discussed in the previous quarter.
Okay, yeah, perfect. That had one-off Sattu. And your quarter 3 volume growth is 0 or plus 1%, which is now improved to over 10%. Now, these are the whole B2C level, correct?
Yeah, this we are talking about B2C only. B2B being we don't focus on the B2B, it is a mix of co-products and byproducts.
Correct. Now, so what we see there is improvement from what is the mitigation strategy, or what is the strategy that you're deploying post this event? And second, what is the progress on the non-West Bengal states, and where are we on the progress there?
As we said, the company is sitting on a very healthy financials. So moving forward, we will try to leverage our healthy financial position to leverage and get inroads into the Eastern India by spending more on the distribution, appointing more new distributors. Probability needs to be made more into the entire rest of East, as well as branding expenditure will also get a thumbs up in this quarter. The company is thinking to appoint a brand ambassador and a celebrity moving forward to make more inroads into the new geographies. And in the states like Bihar, particularly speaking of Bihar, I'm just giving you an example, we have grown 36%, though the base was very low. So it cannot be compared, but on numerical terms, we have grown 36% in Bihar in last quarter.
Okay.
So this is just a mirror. So I think moving forward, the entire focus energy of the company will be on distribution and branding in the coming months.
In the 9 months, has the non-West Bengal grown faster than West Bengal? or is it in line with West Bengal?
It is slightly better, as sir said, because of the lower base, right? So it is better as compared to West Bengal.
Okay. And my last question is, has the initial inertia of a new competitor entering in the form of the name that you mentioned, has it settled down, and that's how you're reflecting in the Jan volume, or what's your reading? And what happened? So was it a price-led competition emerging in the quarter? If you could just tell a little bit on that part.
So as you know, whenever a new player comes into any category, they try to win the market by the price war only. And the same we have seen historically in last couple of years when Patanjali came into this segment, then Fortune also came into this segment. And historically in our market, that is particularly Bengal and then in Eastern India, we were able to hold, retain, rather grow our market share in last couple of years post this players into this category. And the same was with the new player, Imami, which is a big brand in Eastern India also. Though they are not a food category company, but then we will not like to comment on their growth and degrowth and their strategy. But then we are very much optimistic that whatever the dust was there, that is settled in our last quarter, and moving forward, we will be able to grow our revenues, because even in last 2 quarters when the new player came, we were able, you need to appreciate, we were able to retain our market share as well as we grew our profitability on all accounts, EBITDA, PAT, on all accounts. So which gives us a sense and confidence that moving forward, once the price war is over in this segment, we will be able to grow more profitably.
Okay. Thank you very much, sir. I will come back if you have more questions, sir.
Thank you.
A request to all participants, please restrict your questions to 2 questions per participant. The next question is from the line of Naveen Trivedi from Motilal Oswal. Please go ahead.
Yeah, good morning, everyone. So, a bit on the similar line which we kind of were discussing about, since we have seen this sharp volume recovery in Jan, you articulated well about the competition side. But was there also a benefit from the consumer demand side as well? So that apart from how we kind of managing the competition, was there an also pick up in the demand side?
No. So, very good question, Naveen. Very good morning. So, on the demand side, there was no uptick in the demand side in the festival season and post-festival season due to the depressed market sentiments and depressed prices of the raw material, both wheat and gram. The average buying price was lesser than the last year. Both were down to the tune of, say, 8 to 10%. So the overall market of the wheat products and gram products, the overall market sentiment was very down, 1. And the demand was not there, 2. And the 3rd, whatever the GST reduction was there in the categories, there was no GST reduction in our category. We were previous to reduction, we were being taxed at 5%. Post GST reduction in September, we were still at 5%. So the advantage of GST slab reset, our category was not able to get it. So from that angle also, the consumer demand was not there. But then, all said, still we were in a good position. In quarter 3, the revenues were moderate. Only B2B revenues were down, which was a conscious and a willingness, because it is a lower margin category. And on B2C, it was a moderation with 1% growth. And then after the market sentiment down, we were able to grow our profits.
Sure, sir. So, given the new competition has kind of was visible more in the last 6-7 months, was it more active on the modern trade side, or they were also active in GT as well? And secondly, given the competition, demand is kind of factoring in your numbers, which we have, can you expect FY27 can be the year where B2C revenues can be around 9-10% kind of levels?
So answering to your first question, so the competitions were there on the GT channel as well and the modern trade channel as well. So we worked continuously to improve the TAT, the turnaround time, to serve our distributors and the modern trade players. So there we feel that we have an edge because we are manufacturing everything in-house, and that too near Calcutta. All the modern trade players have their facility near the manufacturing units, our manufacturing units. So that way the turnaround time for us was as this is something which we presume is better as compared to the competitors, because the new players which we discussed about, they are not manufacturing it in-house. They are doing job work. So the overall betterment, as we were very much optimistic, that it is because that we have control over the supply chain, entire supply chain, starting from procurement until distribution. So that has helped us, and that will help us going forward. Right now, talking about 27 numbers, it is forward-looking, but we can say that in the immediate quarters, and considering the results, considering the numbers which we achieved in January, in the near quarters, we feel we'll be able to have a decent volume growth in the B2C segment.
Yeah, sure. Just last bit on the gross margin side, like last 2 quarters, our gross margins are close to 26%. So how are we seeing the gross margin going ahead, and any more kind of a driver to the gross margin expansion next year, considering we've been focusing more on the value-added product side? That's all from my side.
So so gross margin is primarily, as you can in our category, around 70 to 80% of the overall supply chain is gross margin, is raw material cost. So we remain very, very choosy and cautious in terms of the sourcing. So we read the market, we see the market trend, and accordingly we procure the raw materials. And that's why that excellence in the procurement of raw material has resulted in a better gross margin in the near quarters. And we feel and we are very much optimistic that the team will work in the same fashion to deliver better gross margin. So the gross margin improvement will be driven by 2-3 levers. One will be sourcing. The second will be the product mix, right? As we move and we increase the spices share, because spices is a category which is growing and delivering growth for us, that will improve the gross margin in the coming quarters.
Yeah, thank you. Thank you. Yeah.
Thank you. A request to all participants, please restrict your questions to 2 questions per participant. For more questions, please rejoin the queue. The next question is from the line of Ishant Lalwani from Ashika Group. Please go ahead.
Hi, sir. Thanks for taking my question. So my first question is on instant mix segment. Can you share the current revenue contribution of that particular segment to overall sales, and what kind of growth target that you are looking over the next 2 to 3 years in this particular segment?
So instant category is obviously it is part of the emerging category, and we cannot take out a category and share the growth on this platform. But yeah, so as we discussed over previous, when one of the investors asked a question on the emerging category. So emerging category is growing at a faster pace as compared to our core category, and the instant mixes falls in line with that growth. And we are optimistic that that category will drive growth for us, both in terms of the top line, they have a higher ASP, and in terms of the bottom line, because they command a better gross margin.
Okay. And also, sir, you mentioned that there is a high competitive intensity. And so what are some marketing initiatives that we are taken to continue our brand building?
Yeah. So if you ask me for this particular quarter, we have we strategize on we strategize and marketed selected categories like suji and maida, which was also launched by the competitor. So there we had a tagline जो खाए उड़ जाए, and we were very much active on the hoardings, on the TV, on the paper ad, and on the digital media. So that way, that was the strategy in this quarter. As Sir said, going forward, we are evaluating working with a face, so that they can face. When I say a face, I mean a brand ambassador type of thing, so that in the coming season, right? So as we said, the sattu was a low performing category for us in the previous year, right? Because of hotter summer, and considering that base and that experience, we feel that entering the new season of sattu, starting this summer, if we have a good face to represent the brand, that will drive the growth for us. These are the key marketing initiatives, and on a quarter basis, we take up strategies. We work with 2-3 agencies, so that whoever provides us the best strategy, we go ahead with that. So our marketing initiative continues every quarter, and it depends on whether we do it for a particular category or for the brand altogether.
Okay. My last question is on the commodity side. So can you share your outlook on the prices of key commodities like wheat for the next 2 to 3 quarters?
So those are commodity prices are very speculative. We were not able to comment. It is driven by the market forces. But then on the moving forward for another 2 months, Rabi crop is going to come in the month of April. So I think the prices will be soft.
Okay. Thank you. Thank you so much, sir.
Thank you. Thank you.
Thank you. The next question is from the line of Ankit from Subhkam Ventures. Please go ahead.
Good morning, sir. A couple of questions. First is now, based on the current competition and the demand scenarios, what kind of growth you are looking at for the company as a whole in the fourth quarter and in FY27? And will you be able to maintain your margins at current level, or is there a scope for improvement?
So on the growth part, as stated, we in the last January month concluded, we were able to give a volume growth in B2C category of 9%. We are optimistic, and with the strong discipline execution, we are optimistic we will be able to continue the same march for another 2 months. For the financial year 27, it will be too early to comment on the figures, which I think we will be able to give the growth figures of financial year 27 at a later stage. And on the margin side, of course, largely as you have seen, we were better in our margins in our category. We think better than our peers and colleagues. All the three, gross margins, EBITDA, PAT, all were good in last competitive quarter also, and in 9 months also, and year to year also. So moving forward, of course, that is a no-brainer. We will strive to continue the same growth.
Okay, and my second question is, you did mention that the competition has come into your categories a few months back, and they were very aggressive on the pricing front. So, in the month of January, where you have seen some decent growth coming back in your core categories, so was there any reduction in the intensity of pricing aggressiveness which was shown by the competitor earlier, or the aggressiveness was the same even in the month of January, and you have grown in spite of that? So just wanted to understand that.
So the competition in the last quarter, third quarter, or you can say in the last 9 months of this financial year, was not only with the new player in the category. It was a two-sided competition. One is with the new player, three-sided competition. One is with the new player, the other with the existing players, and the third, which was a hidden one, because of the soft prices of wheat and gram, which was 10% down year to year. The regional and the small players, the unbranded ones, and the very regional players, they were also able to tap a few percentage of the over the market share due to the soft prices of wheat. Because largely you will appreciate all the bigger players and mid players like us, we continue to hold some quantity of wheat and gram for our blend mix and to continue have a consistent quality around the year, which the local players don't do. So then the competition was from three-sided, as I said, one from local, regional, unorganized players, which was a sudden impact in last quarter, then with the new player and then with the existing player, and in January, we were able to come out of all three, though the prices are still very soft. Moving forward, it will be more soft, but then with a very strong, disciplined execution and leveraging of our buying and selling of our co-products and byproducts, we were able to retain our market share in B2C. Willingly, we have reduced our B2B revenues, and we were able to retain our profitability. And in January, the last question as you asked, once anybody who enters into any category, and if the player is a big one, it will not be, as Amit stated prior to this also, it will take 2-3 quarters for them to do a logical pricing fight. So initial 2-3 quarters will be there on the pricing fight, but then after third quarter and post-January, we are well positioned to take on the competition, increase our market share, as well as increase the profitability, or we may keep a healthy profitability.
No, so my question was, sorry, should I conclude that there was no reduction in the intensity of competition by Mami or other players even in the month of Jan, and in spite of that you have grown, or was there some soberness in the aggression and it helped you to grow? My question was that.
No, so they continue to be aggressive in terms of the prices, right?
Same as Q3.
Almost same as Q3, 1-2% here and there. As I said, we control the entire supply chain, starting from procurement till distribution, and we are manufacturing all the products in-house, right? So we work on the turnaround time to cater to the demand of the distributors and the modern trade customers. So that way we feel we were able to stand ahead as compared to the new players, because they are getting it manufactured from a third party. So obviously their turnaround time will be higher as compared to us. Our products will be fresher in the market. So 2-3 initiatives which we have undertaken in terms of the supplying, in terms of the overall supply chain, that has helped us in the January month. And we are continuously working with our on-ground team to fill up the loopholes which are there in our supply chain, as well as the loopholes which the competitors are unable to fill. So that way we are taking advantage of the on-ground strength we have in the market. And we are also, as I said, we took up category level marketing initiatives on Smoothie and Maida, right? So that way our branding visibility was there in the public mind space. So that way, we feel that has helped us in the January month numbers.
Okay. And are you still carrying the high cost inventory in your core category even now, or you feel that your inventory pricing and now is equal to the unorganized market? Which, I mean, you recently mentioned that.
Sorry, you please complete your question.
No, I was just trying to understand that you did mention that the unorganized, since they don't carry inventory and they were having the low price inventory, so they were more competitive, and you were carrying a high cost inventory. So what is the situation now? Are your prices?
So obviously the inventory levels has come as compared to the September quarter. It has come down because we had restricted on the fresh procurement. But yeah, we are carrying some inventories which are valued at slightly higher prices as compared to the current one, because we wanted to continue or maintain a consistent quality, right? So that way we have some inventories left which are of higher values, but yeah, as I said, it is required to maintain the overall quality.
Okay. And so, are you saying that in next year when you have a low price inventory and you'll have to pass it on to the consumer, the value growth in your category could be lower than the volume growth?
No, so volume growth is a separate thing. Yeah, obviously the ASP growth, obviously once the new season comes in, right, and considering the past trends in couple of years, the prices goes down, right? So we have to follow that trend because that is the industry practice. The players in the industries, the big players also are following the same price trend. So there will be on a quarter to quarter, if you see, obviously there will be a dip in the pricing, right? But as I said, we are working towards the volume growth and better EBITDA and PAT margins.
Excellent. The last question, any new hirings you have done in the last few months at senior level?
No, so that the hirings we will go due to competitive intensity. We will not like to divulge for this platform, but then hiring is a constant hiring is a Bible for any new emerging company, and we continue to do the same in all these segments on the marketing, sales, production, and finance. So we have hired and we will continue to do. On an individual email, we will able to give you the details.
Okay. Thank you so much, sir, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Asha Bhandari from Boring AMC. Please go ahead.
Sir, could you please let us know that what is the will the company will be able to deliver 12 to 15% growth even after the degrowth in Q3? Hello.
So for you are asking about the entire year?
Yes, sir, for FY26.
So FY26, a growth of 12 to 15% is obviously very steep. We feel that there will be a single-digit growth for the entire year. Yeah, but Q4 specifically, as I said, in the January month, we have delivered better volume growth. So we feel that in the entire quarter 4, there will be a higher single-digit volume growth.
But at the same time, even with this growth, we will able to increase our continue, which we have shown in last 9 months also. We will continue showing our increased gross margins, EBITDA margin, and PAT margins, all three.
And sir, what are the growth plans category-wise to retain market share?
So category, so the basic plan is to improve the turnaround time, to supply good quality raw materials, do good quality finished goods in time to the existing customers, to work on the Q-commerce e-commerce platform to do digital advertisement in a very strategic way. Further, as sir also said, we may have a phase for the brand to enter the Sattu season coming summer. So these are the few key strategies we are working on. So these are the fundamental strategies we try to adopt every quarter. But yeah, these are the things we are working on and trying to improve on each and every line item.
Okay, sir. Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments. Over to you, sir.
Yeah, so I'll take that stuff. So thank you, all of you, all the shareholders and all the stakeholders, our investor relation firm Go India for continuous support and trust. Thank you everyone for joining us today. We look forward to again have a healthy discussion in the coming quarter. Thank you.
Thank you.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.